perform.
Thank you so much.
You're an amazing human being and an amazing stock picker.
Always a total pleasure and delight.
Concept. Hi, welcome guys. Welcome to our next edition of FINtastic Talks. And as always, it's I'm highly grateful to have all of you coming in and joining these talks and, helping us make it successful and taking it to the next level. And my sincere thanks and best wishes that I hope all of you are able to start on your personal wealth creation journey. And as I say, it's very important for us to build our second income. Second income, guys, as I define it, is that you must have your parallel investments, and don't look at your investments as your investments, but as a business that you're doing. And that business needs to give you returns. So you need to see, okay, what is my corpus, what is the return it is giving, and you manage it like a business. And at one time, you need to reach a level in your life where your business, the second income, is equal to the income that you earn from your business or your salary. And if you are able to do that, then you are able to achieve a complete financial freedom. Because tomorrow, even if I'm not working, my second income is giving me the income and the money. Yes, it seems like a very far-fetched dream for some of us, or who may not have started on this journey. But for a lot of people, this has already become become a fact or reality. And especially the great markets in the last 1.5 years, if you have been participating, would have really helped on that. So I hope all of us are able to do that. And for today's talk, we have Mr. Balasubramanian with us. He's the strength behind Aditya Birla AMC. He has helped build it as one of the best mutual funds in the country, with almost assets reaching 300,000 crores. It is one of the largest asset management companies, and he's done a commendable job on growing it. He's the man behind mutual fund Sahi Hai and a lot of other industry firsts. So it's with my pleasure to invite him and to have him available with me on our talk today. So welcoming Mr. Balasubramanian.
Thanks, Sanjiv, for having me part of your show. Of course, personally, as you mentioned, for the industry, personally, I'm associated with Bajaj Capital for long, since I think 1994. So one of the longest association I have with one of the leading distributors in the country, advisor rather, I would say.
Many thank you, and it's with your blessings and friends like you that we have been able to achieve our mission of helping make more and more crorpatis through investments. I remember, since we are talking about that time when we started this concept of SIPs, nobody used to know the concept of SIP, when we used to say, invest regularly to make your children lakpati, and that lakpati became crorepati. And now, the SIP has itself become an industry, and it's so great. And, to see where we have reached from where we started. So thank you for coming in. And, one of your introductions I cannot stop giving is one of the most successful campaigns of the mutual fund industry. Mutual Fund Sahi Hai was conceptualized and brought in by you. So, Mr. Balasubramanian, before we go into your background, and, this show, we want to not only cover the mutual fund industry or the markets, we also want to cover you as a person, as a professional, so that there are a lot of people who get inspired. So, one of the things I would like to understand is about you, your family, and how did you get into the mutual funds business, and what was your career like? So it will be great for our listeners to get to know Balasubramanian as a person.
Thanks, Sanjiv. First of all, I'm happy to be part of the show today, given the long association that we have dealing with your father, Rajiv Bajaj, and other members of your Bajaj team. In fact, since I come from South, Bajaj is equally famous in South, in line with the integrated enterprises. That's why we all have grown in the systems, seeing your firm contributing the largest success of the people in the country. Specific to me, so I come, of course, from a place called Tanjavur, called Tanjore in Tamil Nadu, a small town within that we call Melatur. Rich village. When I mean rich village, is not in terms of money, rich in terms of culture. And all Brahmin families living together, about 300 Brahmin families. That's where I began. All education was done in the village, and then of course grew up in the same village culture, and then moved on to study in the cities to do both my schooling, and of course the college subsequent to that. So I came to Mumbai at the age of 21 to pursue one higher education on the one side, and while doing higher education, you also do your say work with somebody somewhere. So after completing my graduation BSc Mathematics, I wanted to actually become an engineer. So therefore, I was looking for some opportunities to be an engineer. And in fact, I would have been a computer engineer actually if I had chosen that path. But I think God had different plan for me. So when I came to Mumbai, then of course I did my post-graduation diploma in financial management, and then got into the finance field. Luckily, in my case, I got into the business because one of my cousin was a leading financial service employee in those days. I was working in a very big position in one of the bank, my cousin brother, and then he gave me an opportunity to work in Canbank Financial Services. So while I was initially for 2 years, I was working with my brother-in-law, who used to be an entrepreneur in Bombay, and supporting him in various activities that he used to have. But the moment I got into the Canbank Financial Services, closer to the stock market, so I could see the outcry systems on a daily basis. I could see a grey market being traded outside the Bombay Stock Exchange. So that, I think, a pulse that came in the Bombay Samachar building when I used to sit. Just outside, you just come out and you only feel only stock market all the time. So that's the I think that whole interest got generated. In fact, my father used to invest in the mutual fund units in those days. Canfigo, and SBI, Magnum, and so on and so forth. Even Reliance shares, like they used to call it Vimal, they all used to buy in a small quantum. So my father had given the entire portfolio in 1992, saying, since you are going to Bombay, you manage this. In fact, I used to keep telling him actually that don't sell these stocks, it all will go up further, go further. When the crash started happening, I started selling my shares and gave the money back to my father, what he had saved. So that's the way it came in. Then I moved into, of course, JSC Mutual Fund as a trader, bond market trader. And I got an entry through a normal, say, exams writing and all, public exams writing. That's why I got into JSC Mutual Fund. And luckily, I got picked up to be the trader in that. And since then, it began. Then when Aditya Birla Mutual Fund joined, started in 1994, my ex-boss, SK Mitra, who moved on here, and then he said, "Hey, Bala, you have to come and join me as a trader and set up my entire investment dealing side." And that's the way I came into Aditya Birla Mutual Fund way back in 1994. And even actually, I was getting married in 95, and my father-in-law, when we got engaged, I was working in the public sector. When I got married, I moved to the private sector. And then my father-in-law was a bit worried, saying, so at the time of marrying, it was public sector to private sector. Am I running a risk giving my daughter to Bala? So that's the way it all began. And God has been kind. I think one, being part of Aditya Birla group, you had some kind of stamp. So I always believe that the Aditya Birla group has got a card value, visiting card value. So that's the way I used to believe, and being loyal to the firm, being loyal to the work that you do. And then grew up from there. And what I'm doing today, I always believe that every 3 years I got changed, not by moving the organization from one to other, but growing within the same organization from one place to other. Only my cabin used to change. All my telephone number, everything used to remain the same. So that's the way I grew within the Aditya Birla Mutual Fund. And today I'm happy that we have now come to a stage where we have become one of the largest mutual fund, and learned along the way a lot of stuff. Learn along the way in terms of educational qualifications, keep building your capability, and then keep learning continuously. Put your hard work. Every Saturday I used to work. Saturday, Sundays used to be one of my working days always. For almost I used to do that for 16, 17 years. Every Saturday, Sunday I used to work. If somebody asked me, where are you going? I used to quietly say, I have some work outside. I never used to say I'm going to office. Other people discourage me. So every Saturday, Sunday, I used to come only for learning purpose. And I was an investment guy. And God was kind. I was also chief investment officer for some period of time, about 4 or 5 years period. And that's where all journey began.
No, superb. I think very inspirational, and especially for so many people that even if you are coming from a village, you can be tomorrow CEO of one of the largest Indian corporations. It is just that एक mission होना चाहिए, passion होना चाहिए, and you must want to do it. Like you came, and at the end of the day, if when your intentions are right, then life finds a path.
Correct.
We were discussing about my father. He says life is like water. Okay, once you pour it, it will always find a way.
Correct.
So,
Correct.
so you will, even if one thing gets blocked, you will get some other opportunity. And what I understood from you is the power of loyalty, which is something I also believe in. A lot of people believe कि यार मैं हर 2-3 साल में shift करूंगा, then that's the right thing. But if you are loyal to the company, maybe you'll feel कि मैं थोड़े साल I may have grown lesser, but after 15-20 years, you don't see any person who's not been loyal, who's at the top of a company. So whether it's
Correct.
mostly so at the end of the day, loyalty does pay. Yes, it may take a bit of time. And the third thing I think we can take away from Mr. Balasubramanian is always keep learning. He was before the talk showing me his Harvard batch behind him. So this is something like, this curiosity to grow in life, this curiosity to learn. Like right now, last year I did a program from Stanford. Right now I'm personally doing a program from Kellogg's. I know, there's so much work, and I have to attend my classes. I've been getting messages from my program coordinator that Sanjeev,
Correct.
where are you? You have a lot of. I have three, assignment
Project
backlog.
work.
Yeah, project work, and then then we group projects are starting, and they say your group will suffer if you don't do it. So there's so
Correct.
much mental pressure, but it's also so exciting to learn about new things, new way of doing things. There's so much, today we are living in such an exciting world where there's so much uh, you know creativity, innovation. It is much beyond what one person can think or one person can imagine. It's so
Correct.
creative, it's so exciting
Correct.
that it's amazing. And so, Mr. Bala Subramaniam, now coming to the
You
people,
can
the
call me
market.
as Bala, Sanjivji.
Yeah.
Yeah.
Okay. No, generally we do that, but no, but so Bala, let me ask you this question. There's an amazing question which I have to take. So there's this gentleman. He's asking. So how would you explain that the comparative returns of Nifty 50 versus the Nifty Next 50 mutual fund scheme? So he's asking whether he should be in the top 50 schemes, the Nifty 50 or the Next 50. How do you personally see as yourself from your views? I know, and that how would these schemes perform, and which one will outperform?
See, ideally speaking, the way I think the market divides, so I think the market is divided into big companies. That's why they come into the Nifty 50. They're all, we call it a large cap. So as the company become large in size, then they become part of the Nifty. Then as you become large in size, your ability of the company to grow beyond a point is also limited. They will become large, big size companies. They will continue to do very well. I'll give you a simple example. Hindustan Liver is part of the Nifty 50. Great company. All of you and me as a buyer of the product, every time we keep consuming it. But as they having now become large in size, they will be able to grow at about 11% rate of growth. 11-12% rate of growth is the rate at which they grow. So as once the size become larger, they make more profit, but the rate of growth I think will get tapered down because the size itself is enough actually for them to get the growth. As you go down the companies, then as the company size is small, your vision to become large in size increases. Therefore, you start becoming a large, fastest growing companies and so on and so forth. Therefore, if you look at the Nifty next Nifty 50 companies, their rate of growth will be higher because every company has got vision. I used to always give this an example. When I used to track Hero Honda in the year 1994, It was a small cap company. I think Mr. Munjal that time had vision to be maybe a two-wheeler company, only focusing on Delhi and northern market. As the vision started becoming, no, I need to become an all-India player, competing with Bajaj in Maharashtra, competing with TVS in South, and then Hero Honda became actually an all-India name. The moment became an all-India name, then the company started growing. Today, one of the largest market cap company. So assuming scenario, I identified Hero Honda kind of companies in the way back in 1994. And knowing very well, this actually falls below the Sensex, below the Nifty, right? Knowing very well if you had bought this company, today the multiplier effect would have been much, much higher. Therefore, any principle of investing, even if we go down the other than Nifty 50 companies, as long as the company in which we are making investment and they are the visionary management, products are very good from a longer term consumer attraction point of view, the company generally tend to do well. That's why if you look at historically, Nifty has given X return. Nifty 50 would have given higher return than the Nifty 50. The reason is small companies who have got a vision, they try to become a mid-sized companies. Mid-sized companies become, the rate of growth generally is 2 times higher than the large size companies. So that is the way I always believe when you have to choose an allocation, have allocation in say Nifty 50, also have allocation in the other next Nifty 50 companies also. That is why I call it a portfolio approach. So I actually invented one of the articles when I wrote in Business Line. So I used to compare, I used to tell people, actually, a lot of people I have got in say Mumbai, I took an example. So I have a house in Cuff Parade, but living in Bombay for so many of the years, how many people would have bought a house in Cuff Parade, or how many people would have bought a house in say Malabar Hill? Very few. But at the same time, a lot of people have also bought a house in say Goregaon, Kandivalli, Borivali, Chembur types. Are they worse off? No. Are they poor? No. Just because they not got the return that Cuff Parade gave, I not got the return here. Now, not that they are worse off. So therefore, from an ultimate this point of view, we need to draw a line as to how much I need to build on the basis of which you keep that as one of your vision. But clearly, from the allocation point of view, you need to have a mix of both.
I think this is one of the best answered question to this type of query, which is a very common query. I think this is one of the best answers. Guys, it's all, as Mr. Bala is saying, that it's all a game of play of risk and returns. The larger companies have lower risk, but they are so big that their chances of growth are also lower. So they will grow at a smaller at a slower pace than the next 50, and then the next 50, then the next 50. Although Nifty first 100 are still very large companies. So I think between the next Nifty 50 and the next 50, there's only a very small difference in the opportunities. And also important is that it is important to track and find the winners, and that's where I think mutual funds play a very, very good role. So again, let's take a question head on which has been coming up between active and passive funds. So as an industry, Bala, we keep discussing and we keep evaluating these things, but a lot of people are now asking this question about index funds versus uh, uh, stock traded funds versus active funds. What is your personal views? And then I will get into my own views on this topic.
Sure. I think ETF is something, it's a growing asset class. So I think in the last, my own career in mutual fund industry for 30 years now I've spent. I think each year the industry gets evolved, product innovation happens, expenses keeps coming down, cost efficiency starts setting in. And from a consumer point of view, from a buyer's point of view, easy way of investing also becomes the way of life. I think US has taught how it can be automated through the ETF and index funds. But having said that, as I mentioned about earlier, I think first question which I said, as you go down the market, the company's aspiration is actually much higher than the bigger company aspiration. Therefore, the rate of growth is high. That is where the alpha comes. Therefore, from a money manager's point of view, the job of the money manager is actually all the time not look at the index and the investor. He looks at the actual individual companies and the base of which wealth creation is always made. He goes with stock specific, sector specific to generate higher return than the market. That is one of his most underwear. No doubt the last 2 years, they would not have done beating the benchmark. But if you have 10 year or 15 year, 20 year, they all have done well. So that's something that being the case, You cannot say that active versus passive is something which one to choose. I would say both were complementary. If I put 100 rupees in, say, active fund, suppose I have 100 rupees to invest, okay, 100 rupees, I have a choice to invest entire money in active fund, or choice to invest entire money in ETF fund, or choice to invest in both. So that's why I call it a complementary product. Even globally also, when asset allocation happens, which I'm sure Bajaj, who's been advising customers on asset allocation, so you don't invest actually only in, say, equity, you invest in fixed income as well. Knowing very well, fixed income gives you half the return of equity. But still I give it because at the end of the day, you need to have a constructed portfolio which will serve your need in the good time, bad time. Everywhere you need to have portfolio construction which actually hedge your portfolio also. If you keep that in mind, ETF will remain as a complementary product to the overall asset allocation that we make on the overall asset allocation equity. Even globally, believe me, people are actually taking US as an example. Even in global market, whether it is a Vanguard or BlackRock, they treat it as a complementary. And Vanguard also don't sell ETF as a cheap product. They sell a differential product. So cheap versus differential, I think both are two different things. So even today, when I go and buy any material or anything, I don't buy anything because it's cheap. You don't buy something because it's available at discount. You first look at actually what is that you want to buy, on the basis of you choose. Even Vanguard has got schemes in the Vanguard schemes who charges about 70-80 basis points expenses because it's differentiated product, but it serves certain purpose of the market. Therefore, total portfolio allocation and keeping the complementary is a way to build the business. Many people come and tell you as investors saying ETF acha hai, ETF mein paisa डाल दो पूरा, fund manager सब खराब है. I don't think it works like that. It has a combination of both. If you look at the portfolio experience, I think ultimately will serve your purpose.
I think again very well answered, guys. So I hope you have been able to understand. See, trying to save money is not the way to make money. Okay, point is that that's a wrong thing. Okay, there is this concept some people are trying to sell to show their knowledge. Okay, bhaiya, if you save some money, that's the way to make money. If you save a 0.5% or 1%, that doesn't mean that you're gonna make money. What you need is a good partner who's going to help you on the right track, help you do your asset allocation. And as Bala himself said, he sold his father's shares when the market was crashing. Now that's where you need an advisor who's going to tell you not to do it, and when the market has crashed, he's going to push you to invest more. Same is with the fund manager. See, if you are doing a Nifty 50, then okay, a Nifty 50 may perform as well as a fund manager because he may not be able to outperform that. But they are fund managers who, even on the blue chip funds, have been able to outperform Nifty 50. Yes, there'll be times when A beats B or B beats A, but over a long time, people are able to create an alpha. And if they are creating that 1.5% alpha, so and that is actually over a period of time a huge amount of money, and the amount of money you'll save is probably 0.5% or 0.75%. But when you go to a small cap or a mid cap, that's where the role of a fund manager becomes even more important, because you will not find an index fund or an STF which will do true justice there, because there the stock selection, monitoring, putting research analysts behind the companies, finding the next generation winner. And today small cap, mid cap needs to be at least 30% of your portfolio if you are young and aggressive, so that's where the future growth is going to come from. And even if blue chips give you 10% and these are able to give you a 15% over 25 years, it will be a difference of between 3 to 4 times. So that's the power of compounding. So guys, life is all about taking risk, and it's about finding winners, and that's what fund managers are about. And so there is an exciting journey in finding the right companies to invest in. There is also finding great journey in finding good fund managers and schemes to invest in. So
Correct.
I think it's a combination of both. Bala, would you like to add something on that?
No, I think I fully endorse your view. The sense some element of risk has to be taken, and some kind of protection has to also be taken. आप दोनों मिलके आप देखते हैं, then overall portfolio approach, as you rightly put it, is something ultimately is the one which drives the investment decision. It's not about okay, now one asset is growing value, you chase the assets. So I always believe that chasing return is actually the worst thing that can happen for anybody. I think even many times, okay, this has done well, therefore this is better. this has done badly, therefore the worst. In the stock market, my own belief is, as you rightly put it, if the fund house or money manager is able to give his best shot all point of time, the longer run actually become like a weighing machine. So that is the way it happens.
Very well. Also, Bala, we are getting a lot of questions on debt mutual funds. And given what happened in Templeton, and what a lot of it has been now been sorted out, but there people still have a lot of queries, a lot of concerns about debt. So what? And I know a lot of those things have now been sorted out. But just why don't you tell people about debt mutual funds, how to find the right debt mutual fund for themselves, and what should they be looking at?
See, debt mutual fund, I think people have not still understood as they seem to understood equity investing. A simple equity investing where people have understood आप पैसा डाल दो 10 साल के लिए 15 साल के लिए मेरा कंपाउंडिंग रिटर्न अच्छा आ जाएगा. Is how they basically take GDP plus something. That's the way it is taken. But the fixed income is something, it actually provides element of safety. It provides element of steady return. So the reason I am saying steady return, I think fixed income has got two components in every NAV. When I calculate NAV every day, there are two components goes into that. What? One is the interest income. It get accrued every day basis. Suppose I lend money to somebody at 7%, 7% keeps accruing every day on my NAV. And second is the value of the securities. It go up and down, go up and down. That is the second component. So because the first component, which is 7% are kind of accrual that happens in the portfolio, it could be 7, it could be 8, it could be, that's called portfolio yield. On the basis of accrual happens, that is the maximum component NAV driver. So the interest is when behaves very little differently, the price fluctuates, and then after a longer term fixed income gives you, but lower power of compounding, but definitely gives a power of compounding, which otherwise you get only in equity at a higher rate of return. The other way to look at on fixed income is the funds that you choose. Of course, I only take this as one example, that people have to understand the correlation between the bond yields versus the price. When the interest rates move up, the price comes down. When the interest rates falls, the price moves up. So the price falls when the interest rates move up, price falls. When the interest rates move down, price go up. So that is a inverse correlation, I say. So this correlation, even if it exists, and a 5-year, 10-year cycles, it get averaged out. Therefore, fixed income is one schemes of mutual funds. So most of the people believe in, I'm putting money in deposits, I'm better off. Believe me, if you put in deposits, yes, your money is safe. I'm not saying money is unsafe. At the same time, most of the people take a decision of investing in fixed deposit for 1 year and 3 years. They don't invest beyond that. Whereas mutual fund पैसा आपका fixed income डालने के बाद आपको बैठ सकता है. You don't need to worry about it. You can give about 10 years, 14 years. There your tax benefit also what you get is very, very large. But unfortunately, the Franklin Templeton issue has of course gone out of proportion in terms of discussion. And fixed income, I have worked in the fixed income market for long, and हम लोग कभी भी नुकसान भी हो जाता है. मैंने ऐसा नहीं बोल रहा actually that mutual fund fixed income में नुकसान नहीं होता है. But only the advantage that we get in fixed income, आपको नुकसान इतना छोटा है, but a total gain that you give is actually drop in the ocean. So है नुकसान है, but नुकसान is actually such a small element of the overall NAV calculation. Over a period of time, it gets adjusted because of accrual of interest that comes in the portfolio. That's the beauty of fixed income. If somebody is very conservative and does not touch even equity as an allocation, I'm happy with the fixed income mutual fund schemes. There are mutual fund schemes, of course, a part of your offering also, and that's something we call it as a duration, 1 to 2 year duration, 2 to 3 year duration. It is nothing but a maturity. मैं 1 साल के लिए पैसे डालता हूँ, उसमें इन्वेस्ट करता हूँ, therefore it becomes 1 year duration. अगर मैं 3 साल के लिए पैसे इन्वेस्ट करता हूँ, निवेश करता हूँ वही पोर्टफोलियो में, it becomes less than 3 years duration. So that is the way I think duration is calculated. Shorter the duration, lesser the risk. Higher the duration, higher the risk. As a relation समझ के, I think people can choose fixed income schemes, but don't worry about the return. Sometimes I'll give you 4, sometimes I'll give you 6, sometimes I'll also give you 8. But again, depending upon the interest rate fluctuation, don't worry about the return. But I think that's something you should keep it as a overall portfolio construct में आपको ये आना चाहिए.
Very, very well said. I think very well explained. So Bala, there are two people who are putting us on a spot. So one, Mr. Ravi Kumar is asking, "Ki, look, I have money for 2 year perspective. Please tell me, agar if it was your money, which fund would you put in?" He's asking between banking, PSU, short-term debt, or a corporate bond fund. And would you recommend a credit risk fund for a high-risk investor? So he's putting us on the spot. He's saying, where would our money go in?
No, no. Of course, if you ask me personally, since you have given me choice of only in the fixed income schemes, at this current juncture, all the three funds, whether it is the banking PSU funds or corporate bond fund or short-term bond funds, all the three run a lower duration. Therefore, I don't run any risk. And given the fact the next 2 years interest rates can go up, and I would rather prefer the banking PSU funds and short-term funds in that sense from at this point of time from investment point of view. And clearly, credit risk fund is something you should not come for 1 or 2 years. You should come for a long period of time. Credit risk fund is like investing for long term. If somebody has got a longer time horizon, credit risk fund absolutely no issues given the fact the way regulation has gone about defining exposure norms, the way they have gone about defining valuation of securities, the way the mutual fund money managers have become, I would say, overcautious. And after the LFS crisis, सब लोग डर गए actually, and the people stay away from credit funds. In fact, the best time to invest in credit fund when the worst time is there. Unfortunately, as Bajaj Sanjiv made a remark, the best time to invest in the market falls. The same way in the fixed income, the best time to invest when the past returns are weak. And credit risk fund actually in the month of March last year, after the LFS crisis, past returns are bad. Future returns are of course unknown. When the past returns are bad, that's the best time to invest in fixed income schemes. And of course applicable for equity also. But fixed income is something, it's a right time to invest. Therefore, even credit risk fund, I would suggest if somebody has got more than 3-5 years period, I would suggest that it's worth investing in that.
Very well answered. I think, again, beautiful answer. So also there's one of our regular viewers, he's Mr. Madhusudan, he's asking this question that he says NFO and debt funds has also become the flavor of the season, and they're very similar to FMPs that used to be flooding the market. So what is your view on that? And is it a right time to do this given that the interest rate yield is low?
See, these FMPs of two kind which is coming in. One is we call it rundown funds, where I say that I buy for 5 years. Then as the fund becomes closer to 5 years, the maturity of my instruments will remain the same. Therefore, it becomes, today is a 5, after 1 year it becomes 4, after the 2 years become 3. That's called rundown funds. The typical FMP funds advantage for you is, though we don't guarantee return, nor we indicate any return as per regulation, we are not supposed to indicate return also. I am prohibited for indicating return. But आपको portfolio construction से मालूम पड़ जाएगा. If I construct a portfolio with all instruments carrying at say 6.5% coupon or YTM, therefore the portfolio yield becomes 6.5% minus expenses becomes the portfolio yield. If somebody actually have got a say 5-year, 3-year lock-in period of money, FMP is something which I think you can block some portion of money. The way I'm saying you can block, even whether we want it or not, we still go and put your money in say bank deposits. Most of the people in Indian savers, 30 to 40% of the money they put in bank deposits. Do we need all the money for emergency? No. Do you need all the money? I think going to withdraw and pre-close, you are not going to do. That you think if money is able to actually closer to your bank, the bank is next door, therefore you are the more comfortable going putting money there. Then you go and see this money every time. You can interact with bank manager and so on and so forth. That's a typical, we are the Indian investor cycles. Because I come from a village background, I knew how my mother and father used to invest in those days. Therefore, that is being the case. I think since mutual funds have become much more tax-adjusted basis, much more efficient. I think FMP, somebody has got conservative investors, if you're parking money in FDs, you can choose that. Adjusted for tax, it gives a better return as well.
Yeah, I know you're not allowed to tell the indicative returns, but these new age, like just for our viewers, these new age FMP-like instruments that are coming around. So, what is the kind of returns do you think they'll be able to deliver in this interest rate post-tax?
See, the one which we recently closed one issue, I can be open on that. Recently, we closed an issue with 60% investing in state government sovereign bonds, and then 40% invest in public sector bonds for a maturity of 5-year period. With the average portfolio construction yield is about 6.25 at the gross level, minus expenses of say 20 basis points. It comes to 6%. Let us assuming inflation is 4. Let us assuming inflation is 4.5. See, 1.5% I have to pay a tax of 20%. So on 1.5%, 20% tax is about 30 basis points.
Yeah.
That means 6% may 30 basis points called up. And 6% in remove 30 basis points your tax element, you get about 5.75, 5.7 tax free. So that is the way to calculate. Mota number I am saying. They're all mota indicative things. So 5.7 is my tax free. 5.7 tax free for a 5-year basis for a considered investors is not a bad return.
Yeah, which is very good. And given the quality of the instruments you're talking about, today,
Yes.
A good bank will give you about 4.5%. The smaller private banks may give you 6% also. And that is 100% taxable thing. If you're in a 30% bracket, you're losing 30%. And if you are able to get 5.7% tax free, then
Yes.
that's an amazing return. So I think to a certain level, yes, for those people who are looking at a very conservative portfolio, then these instruments can make this thing a sense. But also where people lose out in these instruments, guys, where if you are looking at investing, please choose for your maturity not to come into your bank, but make the maturity go into a liquid fund or a PSU and debt fund, because it is important. Because where people lose out is when these instruments mature, they let the money be in the bank for 3 months to 6 months and 7 months without any interest rate. Then jitna
Correct.
aapne smart work kiya, you have lost all that smart work. So that's where, guys, you need to be important that close loop these funds, and that's
If you
what I
can just
tell.
add one thing to Sanjiv,
Yeah,
I think we used to give the dividend plan in our equity schemes.
yeah.
And most of the people choose the dividend plan for equity investing. The moment आपको घर पे dividend आ जाते हैं, you don't invest the money back in equity. Therefore, the
Yeah.
power of compounding, which otherwise you're expecting, is gone. So a
Hmm.
lot of people make these mistakes. They think, I put in my dividend डाल दिया, power of compounding चाहिए मेरे को, dividend भी चाहिए. Then that's a loser proposition. My boss used to say, when my earlier boss used to be there, he says, for power of compounding, you have to put your money back in the same one again and again. Then only power of compounding becomes very larger. Therefore, as you rightly put it, the moment you take the money back in your account, there's a high probability you will not make the investments for better use. Therefore, you may also lose the potential return that you would earn in that fund.
Yeah, and one question, this is something which is slightly new to me also. There's a gentleman called Ravi is asking about passive debt funds. So that will they become as big as the, passive equity funds in the future? So this is, what is your view on that? I have some strong
My
views. I'll
own,
share.
yeah. I think thanks question for this, Ravi. I think my own gut feeling is the passive debt funds may not become as big as the active managed funds for two reasons. One, there will be a mark to market on a day-to-day basis will come. The investor generally, when there is a mark to market loss, knowing very well that when holding this investment for say 5-year, 10-year period, I'll make the return as I expect, and people don't have ability to digest the volatility. Therefore, people always have reservation on such kind of funds and passive funds. Except the FMP, also people generally get worried if there is a mark to market. Active management on debt funds, I think interest rates when it swings very widely, it has a huge. See, I think interest rate is driven by 2-3 things. One, the interest rate itself can go up thanks to Reserve Bank of India rising interest rate. Worldwide, we have seen policy rates keep moving up and down. Second is the spread. When the money becomes too much in demand, suddenly spreads will go up. Suppose today I'm giving at 7%, say 100 basis points over government securities, and tomorrow suddenly money becomes too much in demand. 7 will go to 8, 6 will remain the same. So this is what spread I call it. The money manager invariably captures the spreads in the fixed income space. Therefore, even globally, actively managed debt funds actually are doing much better than the passively managed funds, unlike in equity. So fixed income will remain active managed funds. Whereas an equity will be a mix of both active and passive.
Yeah, I fully agree. See, guys, debt is actually much more complicated than equity today. If we leave out the small caps and the mid caps, so point is that and debt is all about doing active management. A company good today doesn't mean it has to be good 3 years down the line. So at least I have my very strong reservations against passive debt funds, because I think they can go very, very wrong in your portfolio. So there you need an active manager, because at the end of the day, manager's whole life and future, his reputation is at stake. So if something does go wrong, it does have a huge impact on him. So we have to, he has to be very, very careful. And today, if you can get that advantage by paying a very minimal extra cost, it is better. It's like the same thing. I say that whether you clean your home yourself or do you keep a person to help you, you can, so if you can pay a small amount of fees, because thousands and lakhs of people are sharing the fee or the cost of that fund manager. So if you can, by paying a minuscule amount, for what will be for a one retail investor maybe a few thousand rupees, you can get one of the most sharpest brains of the industry looking after your investments. Why would I not do that?
Correct.
And also, let me say that what you see these new apps saying that move to a direct fund, you'll save this much. Bala is from the AMFI, is a very prominent member of AMFI. Bala, let me ask you this question: when we can't compound the returns for the next 25 years, how are these apps allowed to show savings over 25 years, whether the person will remain or not? But today you see a shocking number. If you move to direct, you will save X lakh of rupees, where his portfolio will be a few lakh rupees, because they are compounding that your money will remain for 25 years, it will grow at this rate, you will add this much, and they are showing an unrealistic saving amount. So when there is so much strictness on advice and other things, why is there no strictness there?
No, I think Sanjeev, I think it's very interesting. A lot of people take the advantage of power of compounding for everything.
Hmm.
If power of compounding is the way I think it has to be worked out, I think all of us as a saver would have made huge money. Because as Warren Buffett says, you first save all your money before you start spending. And after that, what is left out only you spend, he says. So while what he's saying is true, I'm not saying no as a concept. But I think every Indian consumers or Indian savers do not make investment on the basis of cost. He always looks at the investment on the basis of what purpose that investment is going to serve for him from a longer term wealth creation point of view or income generation point of view, and so on and so forth. Therefore, the investors do not look at, even I don't look at any expenses on the basis of which, it's like I don't buy any product on the basis of MRP mein utna kitna margin hai, right? We never buy on the basis of that. We always buy on the basis of MRP, which is the price which inclusive of everything. And mutual fund at least has been kind enough to transparent way of doing business. Therefore, everything is getting disclosed. That doesn't mean actually eat into your return. It's actually provide a greater comfort, as you rightly mentioned. It's the people who are actually putting their best effort and ensure that investors' money is managed in a manner, including yourself as an advisor. You ensure that you give money to the people who can manage the money efficiently to generate longer term wealth creation. The power of compounding of that actually gives me a lot more success. The moment it comes to direct, believe me, I have myself a lot of customers who generally talks to me and saying, Bala, I need advice. Okay, now as a money manager, I give them advice. And the same thing is actually applicable for even individuals who take the advice from RIAs or advisor like yourself. But this is something, it is actually for the goodness of, for the good health of the portfolio. Even if it means one has to pay some marginal fees, absolutely nothing wrong in that. Therefore, fees doesn't actually stops your power of compounding growth. This is all, I think, what comes in the, these are all mathematics, right? At the end of the day, calculations, you can just put it. And if everything is driven by mathematics and this calculation, believe me, the way mutual funds given a power of compounding in the last 23 years, you'll be sitting somewhere else. See, in a real life situation, it doesn't work like that.
Yeah, that's true. Again, like last 1 year, some funds have returned 60, 70%, And if anybody thinks that these type of returns will be there in the next 10 years, it's impossible.
Correct.
And these returns will average down to 12%, 14%, 15%, 10%. Nobody can predict, but they'll average down to that amount. So that means there has to be some time of underperformance or low performance. And that is what you guys, everybody needs to be aware of. And then that's where, working with your wealth manager or advisors, you may be able to find opportunities, because there are always contra strategies available. So there's also a very basic but very interesting question asked by one of our viewers. He's saying my mutual funds are giving a fantastic returns. Now, if I was to, I want to safeguard some of my returns and I want to be conservative. So, Bala, where would you move your money? where would you park? Where would you park your money today if you were in my shoes?
No, definitely. See, the way I've been even thinking, I think you put it very rightly, that every bull market follows by the bear market. Every bear market follows by the bull market. Therefore, the market will go through ups and downs. I did some analysis some time back. The market is never one way up. It goes ups and downs. But fortunately, the down of this year is actually higher than the last year down. And it forms a new high, then form a higher lower base. So that's why the market behaves. You put a channel, it will be a channel like this, but within that it will keep moving up and down. So from an investment point of view, assuming if one books profit today, definitely you need to have a mix of hybrid funds. I think the way I look at it, interest rates are very low. Equity market buoyancy will remain for some time. It will fall, again will come back. Therefore, can I ignore completely equity as an asset class? We can't. But therefore, I believe that there are funds like equity savings fund, balance advantage fund. Balance advantage fund, of course, money takes a call. Today, I'm sitting on 40% equity. Tomorrow, if the market comes down, we'll make it 50% equity. There is an element of human intervention. Whereas MIP kind of schemes, which is called regular savings plan or equity savings plan, there is no human intervention except money buying and selling of actually stocks and underlying portfolios actually lies with the money managers. So I would say, if I had to put my money in the current market, but assuming I book my profit in equity, I'm making those assumptions, though I'm not booking my profit, but still I have to do that. Then I'll go for the conservative, not fixed income schemes, but in the hybrid fund.
I think very well said. And I have actually picked something which I say from one of our industry leaders, Nimesh Bhai. Whenever you're confused, move to a balance advantage. So I think
Correct.
आपने भी
Exactly the
same
same thing
चीज
which
ही
I'm all
कहा.
saying. Correct.
Yeah. So I think you have said the same thing, and I think that's now the voice of the industry. Okay, guys, balance advantage is a beautiful product where the fund manager moves you between debt and equity. So he's doing your asset allocation, he's doing profit booking for you, he's making you invest more when into equity when the markets crash. So things which we as an individual may not be willing to do or may not have the heart to do, the fund manager is doing. So even Aditya Birla comes up with a very amazing balance advantage funds or these other hybrid funds. So they are an excellent opportunity whenever you are confused. So there are people who are asking this question: if today I was to enter the market, I'm slightly conservative. What should I do? Guys, go for a balance advantage fund. I personally like balance advantage. I like flexi caps where when I'm doing pure equity, because I will let the fund manager take a call. And
Correct.
also today multi caps are quite interesting, because where you need to where you're giving them even more opportunities to move your money across even more. So as they say, portfolio diversification is very, very important. Either you can do it yourself, or you can let your fund manager doing it. Again, a very interesting question, Bala, from this gentleman Sneh Kumar Sharma. He's asking, what are your views on factor investing mutual funds?
So again, that's the another concept is coming, which is the factor-based investing pool and the base of certain view that get established. There are new product that is coming in. See, ultimately, I've seen in the investment world, you take either factor-based investing or value-based investing or growth-based investing. At the end of the day, all of them actually try and lead you to the same path only. It's like a spiritual, we say, no, ultimately everyone leads to the God. So the same way, if you look at it, whether it is factor investing, all such investment except the style would be different, and that's something ultimately lead to the similar kind of objective that one has in the investment world.
Very well answered. So there's also a question by a senior citizen, Bala, with Mr. Iyer Ganpati. He's asking that, look, with the FD interest rates at a bare minimum, where can senior citizens park their money to get a return of more than 8.5%?
See, in today's condition, no instruments gives more than 8.5% except EPFO, about 8.4% they give for the employee provident fund, and maybe to the extent PPF also has been reduced. But my own belief is even senior citizen can choose the hybrid funds of mutual funds. See, one of the options I'm sure even Bajaj also must be offering, the best way actually the senior citizen to move. I always believe the one of the mutual fund product is reverse of SIP. It works with SWP, which I call it. And that's the best product that one can actually, as a feature, it's not a product. It is a facility. That facility not being used by many people. The best way to actually do is I put the money for long term for 10-year kind of time horizon. But I need only 8.5% every year. I need 8.5%. That means 8.5% divided by 12. That means every month that much of a return that you should get on your investment that you make. Only that much money you withdraw from the schemes every month. Rest you put it for the longer term. SWP is something, in my own personal belief, is I did a lot of analysis and I was advising one of my friend who wants to put his retirement money. I choose the MIP 25. I choose my dynamic bond fund. I choose my short-term bond fund. I also choose my liquid fund. I choose all the three, all the four, and then see if I withdrawn, say 7%, 8% every year, the annualized rate of interest, how my portfolio will look like over the longer term. MIP 25, which is basically a regular savings plan, and dynamic bond fund actually are giving me some money was left on the table as a capital appreciation, even after withdrawing that required rate of return that I was projecting that time. I assumed 7%, I assumed, because SBI was giving about 7% for 5 years. So that is the best way to for the senior citizen to save their money. 8.5%, don't fix an amount, because anyway 8.5, even if you want get it, you don't get it. So that is the only risk that you will make on keeping such kind of target. There's high probability somebody is giving a fixed deposit at 8.59%. There is also probability that company, assuming scenario, God forbid, the company goes for a toss. There is a high probability that lose their money, because sometimes even the rate fixing is also a perennial problem. Instead of fixing the rate, you fix the withdrawal, which is of course nothing, because your principal remains the same, except keeps moving up and down. So you withdraw money, your own money only withdraw. I'm not saying I'm giving a return, therefore withdrawing. But given the fact you are staying the whole cycle, the power of component takes care of your principal, yet you get your monthly withdrawal in the form of SWP.
Yeah, I think very well answered, Bala, very well answered. So, guys, systematic withdrawal plan is a great opportunity for senior citizens. And what we have also done is, guys, we understood this problem. And we have, as Bajaj Capital, launched a special retirement planning calculators and tools, which are amazing. So, this is a place where you can put in all your questions, get a proper retirement plan, and it is meant for people above 58 who are planning for the next 20, 30 years. You can plan that how long do you want your money to last, how do you do an SWP. There are a lot of government schemes also, like LIC comes with a very scheme for senior citizens which gives you an excellent return guaranteed. There are some other government schemes also available. Opportunities there is a 5-year deferred annuity scheme available, which gives you today 8.5% sort of returns. And but obviously, a SWP or a balance advantage fund is very, very good opportunity for them. So, or anybody who's above 58, I would definitely recommend. This is a free service from us as a part of our give back to the society. Please get in touch with your local Bajaj Capital or write to care@bajajcapital.com or call our help center. We'll love to help you do your retirement planning. And there, as the bread and butter of retirement planning is a systematic withdrawal plan, which Bala was talking about, and it is fantastic. It is very tax efficient. It's an amazing instrument, and which all of you must look at. Also, guys, we have a lot of questions on life and health insurance, which we are not covering today. But let me just say, कि, look, if you are asking a question, कि health insurance होनी चाहिए, that हो तो होनी चाहिए. And does your company policy cover you? No, because that covers you only till you are with the company. And what happens post 60 or post you leave your job? So you must have your own private cover. And again, we have a insurance planning tool where you can look at your existing cover and what is the right cover that should be there. It's again a free service we have launched during the pandemic. Right to care at bajajcapital.com with the information on your policy, and we'll give you a free insurance portfolio review. It will be our compliments. Same is with life insurance. So you can send your this thing, and maybe we'll do another talk where we will do a more deep dive into life and health insurance. Today is not the right day to cover that. So one last question from our chat, and then I want to ask you a question about your forthcoming IPO, because I think this chat cannot be complete without that question. So one last question that I'll take is a very interesting question, which is asked by this gentleman called Archit Maria. He's asking, what is your view on real estate as an investment and protector of wealth? So what he's
See, real
basically
estate.
asking us is that, okay, now since we have a lot of people have made a lot of wealth in the equity and in the share market, is it the time that they diversify into real estate to conserve a bit of their wealth?
I think it looks like real estate as a sector would be probably back in demand. It will not lead to a price increase. At least it'll actually have a lesser fall. At least I don't see it price falling. I don't see the fear of price falling or demand going down. May not be there for one simple reason. I think post pandemic, the people who have realized that I need to have a house, especially residential real estate, that something has gone up. And second, in the last 3 years, because demand was slowed down, in general, most of the people who have built huge inventory, they have been managing to sell their property. Therefore, incremental construction activities have not been as high as what we have seen in the past. Therefore, there is a reduction in inventory. Therefore, new construction is not there. Therefore, the demand has now come to equilibrium. So, supply and demand has come to more towards demand. This, in my view, will lead to an increase in prices marginally. I think more than anything else, even the rental. I think today people also, the young population wants to work, and they also now rental also now started picking up. So keeping that in mind, I would probably not hesitate that yes, you can have one of the investment as real estate. But having said that, I think if you look at any calculation, any manner, the investments, see, real estate you have to consider two parts. One, for staying purpose. Second is for the investment purpose. If it is investment purpose, financial market instruments that we spoke in the last 1 hour are the best. Because exit easy, liquidity is more easy, power of company is real. Whereas in the case of real estate, if you buy, okay, power of company in the longer term, it comes no doubt, but it's not as big as what you get in the other capital market instrument. Second, you also have the issue of what do you call the maintenance and other stuff is also eats into the return. So that's something I think you have to keep in mind. Unless you need it for the purpose of real use, or one extra house, you can keep it as a backup. That something is idle, but not diverting a lot of money from the capital market into the real estate and have a huge pile of investment in real estate is not something advisable.
Yeah, I think Bala's answered it superbly. I can't add anything there. I think it's very well answered. That's a golden advice. So, Bala, I know we are almost off time and we have to ask about your IPO. So, I know this IPO is opening soon. I am at least very personally very excited to be applying for it. So, just tell us a little bit about your AMC. What is the growth plans, and what is the kind of I know you can't say, but what is the kind of value creation in the long term? What can we expect from Aditya Birla Mutual Fund in the parameters of what you can talk to us about?
Sure. Now, I think Sanjiv, we just closed our issue last week on Friday. We closed the issue, and we
Oh,
got oversubscribed about 5.5 times.
oh, sorry.
And
So I'm a bit lost here. I thought it's
no, no, no,
tomorrow. Tomorrow
no,
it's
no, no.
closed.
It closed last week.
Okay.
And we had a good subscription, good response was there. And we valued the company at 20,500 crores, which probably I can say at a discount to the any potential either listing price or discount to the comparable listed space in the industry, AMC industry. See, the best way actually the market always decides any pricing. These are rocket science. So I have X, if I already have somebody listed in my same space, either I have to value the premium or at a discount, whichever way you take it. So that is the way normally it happens. Therefore, we have done the pricing in a manner which I call as reasonable pricing we are given to the new investors who already subscribed. Second, the book that you would have seen, some people would have read in the newspaper, the people who came on board, both in the anchor investors, QIPs, qualified institutional investors, and HNIs retail, good quality investors have come from the QIP investors, anchor investors. That is disclosed in public domain, is available. The anchor investors who have come, there are long-only investors have come. The reason they all have come, the AMC industry is actually in the, despite me having worked in the industry for 30 years, I can still say we are not even scratched the surface. We are still a long way to go. Penetration in the mutual industry is very low. Customer base in this mutual industry is still growing. And that's something reflects the kind of growth that could come in the AMC industries. Worldwide, AMC industries in the US is the largest industry, even higher than the bank. In India, mutual funds are only 20% of the bank industry size today. But the way interest rates are behaving, the way the interest rates are so low, probably I would assume for a long period of time it will remain like this. Then mutual funds will become the natural investment vehicle for savers in the country. That is where we are operating as Aditya Birla Mutual Fund. Clearly, the brand plays a role. Commitment for building the business to the next generation is very, very high. And the last 25 years of experience at Aditya Birla Mutual Fund have given reasonably good experience to the investors. Leave aside some ups and downs we would have seen in the last 25 years of journey. But otherwise, as a consistent performance that we have given good investors, from a shareholder's point of view, I think we are one of the profit-making dividend distribution aims in the country. I think a lot of people ask me actually, well, what is the difference between Zomato and AMC business? AMC generate cash, and that's something is being distributed from dividend. A company like they're all new age platform like Zomato, also is a new age platform. They build business for the future. Probably they will start seeing the profit coming to them by the end of say 5-7 years. But they are being valued on the basis of the potential that they bring on the table for the future. So that is the way every business gets valued. I think for mutual fund business, if you have to look at the potential, is very, very large in terms of size that can grow, in which Aditya Birla Mutual Fund is extremely committed to stay on course and build our business further to new heights. So that is the broad pitch that I have given to all the investors. I was on TV last week pitching for this IPO. More or less, I said the same thing what I said in the public domain as well.
Very well said, and we are very excited to looking forward to your listing and continued growth post that. And it's great that you took out time. We have got so many thank you messages from everyone. So thank you, Bala. It was supremely insightful, and thank you for taking out time. I hope we were able to add value to our listeners today. Thank you, everyone, for joining, and thank you, Bala, again for making out time to be with us today.
Yeah, thank you. Thank you.
You perform.
Thank you so much.
You're an amazing human being and an amazing stock picker.
Always a total pleasure and delight.
Concept